Digest of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
And welcome back to another episode of the Weekly Market Recap hosted by the CSE. I'm your host, James Black, filling in for Anna Sarin, who's away on vacation this week. And as always, or mostly always, joined by Bruce Campbell from StoneCastle Investment Management in Kelowna. If you happen to be in Kelowna one of these days, go visit Bruce and Jordan. Nice guys. So Bruce, heck of a week in the market since we last talked. More banks kind of dropping like flies now. A lot of interaction with the Fed and Treasury Secretary Janet Yellen. We'll get into that this week. Trying to fix the problem or at least prevent more issues here in the market. We'll talk a little bit at the end about CSE issuer news and maybe some opportunities that are going to come as a result of some of this market chaos. So perhaps we start at the very top, which is, the Fed interest rate hike. Just the other day, another 25 basis points tacked on. Maybe just describe to our viewers and listeners today what is happening with this Fed rate hike and what it's meant to do.
Yeah, so this is a continuation of the inflation fight that we saw last year, and pretty anticipated here. But the thing that's really changed and been super volatile is where things are moving and where things are at. So if you go back just a few weeks ago, I think it would have been the 8th of March. At that point in time, the market was pretty much pricing in a 50 basis point increase, and they only increased interest rates by 25 basis points. And that's to fight inflation. The challenge that they're running into right now is you're having these issues with these banks. And so, we've seen a few in the US now that have run into trouble where people are taking out deposits and then, with their mark to market on their fixed income portfolio, they have this big hole, and it means that the Feds had to come in and help out. And so if you look at the chart here, this is just looking at where the market was anticipating the Fed funds rate. So at the very top pane, you can see that during the year, they were thinking that rates were going to continue to go up. That was on the 8th. The bottom pane is on the 24th, and you can see that now they're pricing in interest rate cuts, which is a pretty big swing in only a very short period of time. Typically, we don't see this. It tends to be a lot more smooth where, okay, yeah, they're cutting and then they go, or they're raising and then they go sideways for a bit and then they cut. This is just what the market's anticipating, and this changes all the time. And this is the most recent, and this probably has a lot to do with what we're seeing in the financial sector with these banks having trouble right now. And this could change if we saw some stability there. Then perhaps the market goes back to where they think that the Fed stays fairly stable with their rates. Interestingly enough, in the press conference, someone specifically asked the Fed chairman. They said, you're telling us that there's going to be no rate cuts this year, and the market's pricing those in. What's the market missing, or who's wrong? And he basically, I'm paraphrasing, but he basically said, no, we're not going to be cutting rates. So it'll be really interesting to see if the Fed actually forces, or the market actually forces the hand of the Fed here.
Yeah, and I read a really interesting article this morning, shared internally, but it was for public consumption, was that a lot of the issues around these banks getting into trouble was them trying to seek yield, but through very safe instruments, not subprime mortgage-backed securities, bank notes, things like that. And so they kind of got hooked on 2% interest yield in an environment where people were borrowing for nothing, and all of a sudden things ramped up to, as you say, fight inflation. And now I'm wondering, these people really got to start talking to one another, because you're starting to see this issue where, the Fed's kind of saying the rates are going to keep going up a little bit. We have to still fight inflation. Is it really our fault that you overinvested in these 10-year treasury? But the problem is circular, because the money was flying free like water because of the low interest rate environment during COVID. So everyone's kind of blaming each other, but we're going to have to find solutions, or else there's going to be some serious issues. Hopefully that kind of explains how I see the issue. But do we have any similar exposure in Canada, you think, with our banks, or is this a U.S. and maybe foreign phenomenon, as we've seen with Deutsche Bank and obviously Credit Suisse last week?
I mean, our Canadian banks have always been really large and stable, and we have a completely different system than the U.S. Effectively, we have what would be a duopoly in our system, whereas there they have a much more competitive system, but they have a lot more instability in their system, and so we're in pretty good shape here in Canada. I suspect that the regulators have been digging into things in the last couple of weeks to make sure that the banks are on solid footing.
Sure, of course. Now, you tipped your hat to what is one of the controversial issues here is deposit insurance. So, FDIC in the U.S. Obviously backs insurers holdings up to $250,000 per account or account holder. I have to get clarity on that. But at the end of the day, a lot of people, especially these companies at Silicon Valley Bank, had far in excess of $250,000 in their accounts. So, the Secretary of the Treasury, Janet Yellen, comes out and says, well, we're going to protect investors. It's going to be broad scale. We're going to go and take several measures to make sure that people aren't going to be exposed to this changing interest rates and the crunch that's happening at the banks. And then there's a bit of a flip as of yesterday. Her saying basically, maybe that's not going to be the case. So how are you reading the situation, and what's really going on here with depositor insurance?
Yeah, she's been really inconsistent with her messaging, that's for sure. So, if you go back 2 weeks ago now, today, that was when we ran into the issues with Silicon Valley Bank and Signature Bank New York. And effectively, they were closed. There was a lot of worry from a lot of those depositors because they would only be covered up to that $250,000 limit. And then lo and behold, the Sunday came around, which will be 2 weeks this coming Sunday. And the FDIC stepped in and said, nope, all those deposits will be backed up. And, if you had 55 million or, $55, you're going to be covered the exact same way, which was a big sigh of relief for the market. Things stabilized a fair bit, knowing that, those depositors wouldn't actually lose their money because they had it in a bank. Probably also calms a lot of the fears of people running from these regional banks up to the big national banks. But then, on Wednesday, Janet Yellen was speaking to Congress, and she basically said that the uninsured won't be insured by them, which again spooked the market. And there was a fairly significant sell-off that afternoon, basically from the point where she spoke at 12:30 Pacific time until the market closed at 4 p.m. or at 1 p.m. Pacific time. And she's since sort of walked back a little bit from that, saying that, they would insure the system. I think she probably overstepped her bounds a little bit because from what I understand, it's not really her decision to be making. That's a committee decision, and it would involve more than the Treasury Secretary. It would involve the FDIC, probably the Fed as well. The market's been calmed a little bit in the U.S. on that front. That being said, we continue to see other challenges, Credit Suisse and now Deutsche Bank.
Right, exactly. Explain to me what this chart was when she spoke on Thursday. Is that when the thing fell off the map, or?
Yeah, so this is Wednesday, and if you kind of look at it, if you look at here, it was going fair. The market was kind of stable. This is the S&P. It wasn't really doing too much. The first blip there is after the Federal Reserve announced that they were going to be raising interest rates by 25 basis points. The market gyrated around a little bit, and then they went into the press conference. The market had pulled back and then was starting to rise again. And then you can see where it basically goes right off a cliff in just the last 30 minutes of trading. And that was at the point where Yellen had made her comments to Congress.
Okay, well, other than our reaction, there's been bond market reaction to what's happening here in the market. Let's just dig into that for a second. So you actually gave me this chart, which I believe is the 2-year bond chart. Is that what I got here?
Yeah, that's right. That's the yield on the 2-year US bond. Okay.
So a 2-year bond, explain to us exactly what's happening now with this information that's it's spreading through the market. I see things going down on the right, the interest rate. So what's that specifically a reaction to, and why is it going down?
Yeah, I mean, it's going down. We'll talk about that. But the one thing I really wanted to kind of highlight first off this was just the volatility. You can see that, we've been in an extremely volatile environment for the last probably 20 months now or so. And this is just a 6-month view of where that 2-year yield was. And you can see how even then some of those moves are volatile. But in the last 2 weeks, that volatility has ramped up. So you can see where, from the sort of January period up until March 8th, it went straight up, peaked at just over 5%. And now that 2 years at, call it sort of 3.8%. And what that's telling you, or what's happening here, is that investors are buying bonds. They're buying bonds. And so the bond price is going up and the yield is going down. They will go in inverse direction. And there's a couple of reasons that that's the case. One would be that you're seeing investors concerned about this financial crisis. And so they say, where can I go with my money? Well, I want to go into short-term US government-backed securities. So that's the 2-year. And then the second thing is that the market could also be anticipating that there's going to be more consequences of all of these bank instability on the economy. And so that we could be getting closer to what would be a recession. And we started to see that in the last few days with the specifically with the 2-10 yield curve. And then a lot of the other yield curves are the same way. But what we saw was that yield curve was inverted to the point of, I think it was around about 108, minus 108, where the 10-year yield was higher than the 2-year yield, which is, the other way around, which is very rare. And now that's started to normalize, and now you're down about only negative 40 basis points, but still is quite an inversion from a historical standpoint. And what that's telling you is that the market feels that we're getting closer to that recession. Historically, what we've seen is the yield curve inverts, and then as we actually hit the recession is when it starts to normalize.
Right. No, and as you've stated in our chat before, there's actually some opportunities that might arise as a result of this environment. And you've had this chart up here to kind of exemplify where there's a couple of assets people can maybe look at to consider as a play in this market. Can you explain this one a bit more?
Yeah. So if you look at this, there's 3 different panes on this. The top one is the 2-year yield. And then we've shown out on the exact same time frame technology, and then gold on the very bottom. So technology is in the middle. And you can see that as that 2-year yield started to drop, well, what you saw was technology shares start to perform. And again, if you go back to, sort of the end of 2021, beginning of 2022, when rates started to go up, technology shares were the ones that got kind of hurt the most. And then gold shares have also done well. We've seen the price of gold spike up. It was trading over $2,000 an ounce. And that's based on the fact that, we're now starting to see what the market's perceiving as real yield. So the yield minus inflation, where it's going to be positive. And that's a really good environment where gold typically does well. And so the gold shares perform with gold.
You said with gold, there's a relationship to inflation. It's the threat of inflation has a direct impact on the price of gold. Is that how it works?
Yeah, I mean, there's a couple different
rates go up
there.
Yeah, I know it's complex, but
yeah. So I mean, gold has always been thought of as a good hedge against inflation, and kind of the classic gauge that most people sort of talk about anecdotally is the price of a man's suit. A really nice man's suit should cost about the same as an ounce of gold. And you sort of think about that going over time, it carries the value. And so you would expect that over time, gold is going to go up with inflation. But in sort of the shorter time frames, what happens is as real yields, so that's the yield you're getting paid minus inflation, as that starts to improve, and you're seeing that inflation go down and rates going to stay up, then at that point in time, gold also tends to do well. And that's what we're seeing now, is that the market starting to anticipate rates and inflation starting to come down, and now you're seeing gold appreciate.
Beautiful. All right. This nice segue into our CSE issuer news. So we've been very busy at the exchange, obviously, with a lot of new mining projects, a lot of them in the battery metal space, obviously, but mining for gold is always a traditional sort of play here on the CSE for some of our companies. And I also wanted to just highlight a new issuer from the last week here. So Fandex Technologies. And I thought this was an interesting one. They came to the office. We'll be, you'll be seeing a clip on our CSE TV very soon with them opening the market. And just to rattle off what they do here, they are a nanotechnology company focused on developing products that reduce the transmission of pathogens with a wide range of applications in healthcare and other industries. Specifically, the Repel Wrap film is this product that they're building, and this is being developed out of a research institute. And this is actually going to have application on maybe not the most comfortable of topics, but catheters are going to be coated in this Repelware. And it's just a very interesting company in the sense that we're starting to see technology companies still come to market, and hopefully that maybe correlates to the chart we just displayed there, Bruce, around companies that maybe are in developing something new and different and innovative, and using the public market to finance it, because I can't imagine they're going down to Silicon Valley anytime soon and raising tons of money. So, or maybe they will, but there's some issues right now. So. That being said, I just want to welcome them. Fandex will be having more to show in the near term. Anything else you're looking at these days that has your interest based on what is happening in the environment?
I mean, things are very, very volatile, which can create opportunities. There's, some sectors that have been really overdone, and there's some other sectors that are, starting to get overdone to the top. So we keep our eyes on that, and then, sort of as things evolve with this these financial challenges with the bank, that's obviously has a big impact on, kind of the macro view and sentiment of the markets.
Yeah, no, absolutely. And so heading into next week, anything you have your eyes or ears peeled towards?
Nothing specifically. There's nothing on the calendar that we're, really watching. It's just kind of all of those macro events.
Yeah. A lot of things you can't plan for, I'm sure. Well, with that, Bruce, I'll let you get back to work. It's Friday, and I'm sure you have a few more hours to put into the office before you go home. So thanks again for watching. If you are, please subscribe down below. This is CSE TV, or subscribe and like if you're watching on social media. We really appreciate it. I'm James Black. That was Bruce Campbell. We'll see you next week on the CSE's Market Recap. Thanks so much.